Well, the median price in Nashville's housing market is negative. Not only that, but Amazon just announced layoffs. So what am I looking for in Nashville's housing market that will signal if this decline will continue? I'm going to talk about leading metrics that I look at. I'm also going to show you a very practical way you can protect yourself if you are planning to buy in this market. So without further ado, let's take a look at the data. So here you can see that Nashville home prices are down 2%. Now what this means, just so you all know, this is the median price. So this is what buyers are paying, not what sellers are getting. So what does that mean? Well, Greater Nashville Realtors last year reported January at $490. Okay, and so what I do, I take that same snapshot, that same pool, and I plot it, I track it every single day. And what you can see, we're at $485 right now. So if we were reporting today, they do this on the 5th day of the month. If we were reporting today, it would be $485. I suspect we will be in Nashville reporting a negative print for January. Now, the truth is that these are basically flat prices. This is not real price relief, but if it continues, it would be. Is there a way for us to see what February is going to be? There actually is. So what we do, we can come down here and look at contracts. And when we look at contracts, this is actually what I care most about. What we can see is, again, you look at the contracts, it's been pretty flat. 2025 was very flat. We're going to talk about why and what happened there. But if you look, 509 is where we're at right now, 509. And if you go back to February of last year, what you see is we were at 499. Okay, so if we just use contract price, what we can see is I would expect our prices to be about 1 to 2% higher than they were last year for February. Again, neither one of these, both up and down, signal anything other than prices are basically flat right now. So are there other metrics we can use to see the health and direction of this market? Well, we can look at active listings and we can see we have almost 1,000 more. It's really only about 800 now. So it's been shrinking. This number's been shrinking. Now keep in mind, we just had a massive ice storm. So it's very clear that this ice storm is impacting both active listings and contract volume. Contract volume is now negative for year-over-year contracts. I expect this to bounce up in the next couple weeks. We get through these snowstorms, this crazy cold weather, and this should bounce. If it doesn't, or if it doesn't recover, then we've got some serious things to consider. And look, we know that there are things going on in this market. Amazon laid off another 16,000. They laid off 16,000 last fall. They laid off another 16,000. We know a good chunk of those are coming from Washington. It's very hard to gauge how many are coming from Nashville. If you look at the BLS, overall, Nashville is extremely strong. We're at another all-time high for employment. Nashville's unemployment rate right now, according to the BLS, at 3.1%. This is basically full employment. When you look at the wage growth, it's been hovering right around 4%. So when you combine wage growth of 4% per year, basically full employment, then I think these layoffs are something to pay attention to, but there's no real hard data that shows that actual employment is going down in Nashville. Now, again, if you know of something else, I would love to hear it. You know, I track the Warren Tracker, I look at all these things, but overall, the data still seems to be strong for jobs. I think that bodes well for Nashville's economy. Now, mortgage rates are down almost a full percentage point. Okay, so you have full employment, you have wage growth of 4%, you have mortgage rates down almost a full percentage point. On the active listing side, we're still seeing active listings shift downward. I really want to see this shift up because if you look, this is year-over-year change. It's just the same date. That's why it's so jaggy, because it's not the same weekday. It's just the same date. But what you can see is we've trended down on our year-over-year growth, and we are now at a 14-month low for where year-over-year growth is. And really, we're almost at a 24-month low in where year-over-year growth is for active listings. Really want to see active listings grow, because here's the deal. Even if prices don't change, active listings growing gives the buyer more value. You have more options to choose from, and the better value will show up when we have more options. So I'm really hoping this grows. It is shrinking right now. Now, let's take a look at price cuts as a percentage of active listings. This is also shifting towards the sellers. Now, if you look close at this, what you'll notice is that all of 2025 and all of 2024, 2025 had more price cuts as a percentage of active listings than 2024. Now, why that was so significant is not only was it more price cuts, but active listings had grown tremendously over 2024. So we were entering 2025 very soft. Now, if you remember, up until this point, right here in May, I called, in fact, you know what? I'm just going to find it, because I think you all think that I'm just Mr. Bull over here because I've been much less, but we're going to find this. On May 15th, I posted this chart and I said this is a critical threshold, and we have 35% more active listings, and still a higher percentage of listings have dropped their price. That is massive. Look for it start showing in July closings. Now, if you talk to anybody, they would say in July of last year is when things started getting soft. Now, when they started getting soft, one, the buyers that I had were actually getting much better deals in the back half of last year. But the other thing is the data started shifting again. And that's when I think I lost a lot of you, is I started reporting that it's actually starting to shift back towards the sellers. I was pretty disappointed with active listing growth, which stalled. Contract volume started hitting above where 2024 was. And so I started shifting back, saying, hey, this isn't as weak as we thought it was. Now, the end of the year, it was very soft, but what we're seeing is still a shift towards sellers. This is the first time we've seen active listings, contracts, price cuts as a percentage of active listings all start shifting back in the direction of sellers since really 2023. And so it is concerning to me. All the signals that I look for are shifting towards sellers gaining their hand back. And look, everybody's going to report it's been a buyer's market. And I'm reporting, hey, it's actually shifting back towards sellers. You guys want to pay attention to yesterday's news, that's fine. What I'm showing you is where things are going, not where things have been. Now, I want to take a look at this, and then I'm going to show you, someone asked about East Nashville, so I'm going to show you a property in East Nashville here in just a minute. But let's take a look at the market pulse here, top 15 cities. Nashville, we see that with the 1 to 2 million range, we have more supply than we did last year. Everywhere else, we've got basically flat or less supply. Pretty wild. If we look at Mount Juliet, got some buyers in Mount Juliet right now, very tight. It's very tight, but 650 to a million, much looser than last year, but things are starting to tighten up with contracts. Let's go to Franklin. Franklin, the $2 million, lots more inventory. Let's take a look at the inventory versus the contracts. We can see we have 27% more inventory, and contracts flat. Franklin is actually a much better place to buy a $2 million house this year than it was last year. Look at active listings in the 650 to million, popped big time, 25% up. Under contract, contracts are down. It's a better time to buy in Franklin if you're in the 650 to a million range. Let's take a look at Nolensville. Nolensville active listings, 46, 46, 45. Lots more inventory in Nolensville. Let's take a look at contracts. Contracts up as well. So Nolensville's tightened up, and that's what this supply is. It's just a ratio of the contracts, the active to contracts. You can see it's lower. And let's do one more. Let's actually do Spring Hill. I'm curious about it. Spring Hill, more inventory relative to contract volume. Okay, now what I wanted to show you. Here's my map of Nashville. The red is shifting more towards sellers relative to where they were last January. Okay, so this doesn't mean it's a buyer's market or a seller's market. It just means it's shifting towards the sellers or towards the buyers. If you see dark blue, that means it's way colder than it was last year at this time. So anytime you see a dark blue on there, you can see it here, double the inventory and none under contract. So that's a major shift blue right there. Let's look at another shift blue. This is right by Costco. Almost double the inventory, went from 9 to 15, and now we have none under contracts. So it's a dark blue. This is really a signal, if you're a buyer, of when and where to buy. It's a buy signal if you're in the dark blue areas. If you're in the dark red areas, it's more of a sell signal. It's a good time to list your property. Look at this. This is in Edge Hill. You can see prices dropped almost 10% in this neighborhood, and yet it's so much hotter. Why? Well, I think probably because prices dropped, people are more interested in the areas where we've seen home prices drop. And you can see here from 2022, the blow off top. But let's take a look at East Nashville, because I had someone say, hey, can you look at East Nashville? I felt bad I didn't do it last week. So let's take a look at East Nashville. We can see East Nashville. Here's where all the Oracle is going to happen. We've got the Nissan Stadium coming in. So a lot of development over here. There's been a lot of areas where prices have fallen. You can see in Laughlin Springs, prices are down about 5%. Now, what that means is that if we look at just this rolling median here by price per foot, we can see last year it was about $465 per foot. It kind of dropped. You can see it dropped on the latter part of the year. And now we're down to $442 a foot, so about 5%. But you can see in the long run, I mean, prices have been going up quite a bit in this area. Now, again, look here in July, price cuts peaked. That's when prices started dropping. Really interesting to see that. And then if you want to look at every single sale plotted, that's what this is. And you can actually dial in by what size type it is. You can see on the smallest, you can see we got some new lows last year. If we go up just a hair, you can see another couple new lows, and on. All those end up adding up to prices dropping. Just pretty interesting. You can see they peaked out here right at the end of 2022, and they've been flat to declining ever since. But Laughlin, that's Laughlin Springs. We can see McFerrin. McFerrin's down about 5%. But even as it's down, we're also seeing, look at that. You can just see how things popped off at the end of 22, and they've been down ever since. When we flip to sales price, okay, I toggled from price per foot to sales price. Even though the median price may be down year over year, this is an area with a little bit less volume. That's why it's more volatile. But here you can see higher highs, higher lows. I mean, prices kind of trending up right here. What I wanted to show you is here in the Rosebank area in East Nashville. Let's take a look. All the 3-bed HPR detached houses. When you plot those, you see two that stick out. One is 810B Rosebank Avenue. Okay, this sold for $730 in March. Okay, look at what happened in 2022. They bought it for $870. They had a $140,000 loss. Let's take a look at this one. This one sold for $676. But let's go back to 2022. What did they buy it for? They bought it for $600 in March of 22. So why the difference in outcome? Well, if you plot both on a chart like this, what you will see for the size, for the HPR detached 3-bed, they bought at the top of the market. And so when they had to sell into a much more difficult market. They ended up taking a $140K loss. Whereas Northview bought same size in March of 22, but guess what? They bought low for that type and size. They bought $270,000 lower than where that other one, and guess what? They were able to sell for 10% more. So even though you could say that the home values for this type and size were dropping, one ended up gaining and the other ended up losing. You make money when you buy, not when you sell. You hear that? You lose money when you buy, not when you sell. Make sure you're not an outlier. That is what I'm trying to show you here. This is a perfect example of not being an outlier. If you're an outlier on the high side, You're going to end up losing if you have to sell in a couple years. I'm not telling you where the market's going. I told you I don't know future home prices outside of some of the hard data and directional stuff we have. But what I can tell you is that if you buy low for a similar property in a neighborhood, you are hedging yourself and protecting yourself from being a loser if you have to sell in a year or two. If you buy high, you are setting yourself up for failure. You can position yourself to be protected if you are worried about the data. And with that, I hope you all have a great rest of the day. Thanks for watching. I look forward to seeing you next Saturday. Thanks a lot.